Hi everyone, welcome to the session. In this session, I'm going to discuss about IAS 36 impairment of assets. Okay. Now let's look at the objective of IAS 36. IAS 36 ensures that the assets of a company are not recorded on the balance sheet for more than, this is very important, more than what they can actually be recovered for. Okay. In other words, assets should never be shown at a value higher than their recoverable amount. Okay. So this is the main purpose or objective of this impairment of assets standard. Basically, what the standard requires is us to compare the carrying value of the asset, I will discuss later on, to compare with the recoverable value of the asset. Okay, if the carrying value of the asset exceeds the recoverable value, then that asset is considered impaired. Okay, so that asset is compared impaired. So basically, let's say the carrying value of the asset is 100 and the recoverable value is 90. So your carrying value is more than your recoverable value. Okay, so in that case, you cannot overstate your assets value. Okay, so therefore, this will, if you overstate the value, this will be, this will not provide a fair presentation of the financial statement, because the shareholders and other investors, the stakeholders, they truly rely on the financial statement. So therefore, we cannot provide any misleading information to the shareholders. So in order to avoid that, what we need to do is we need to apply IAS 36, which is the impairment of assets. So basically, no deliberate overstatement, no deliberate overstatement or understatement of assets. Okay, so this is what this standard requires us to compare. Basically, you compare the carrying value of the assets with the recoverable value of the assets. Now, which assets are not covered by IAS 36? These are the standards which does not apply IAS 36. If you look at the inventories, inventory has a separate standard, so therefore it is, the measurement is very unique to IAS 2, so which those rules and principles will have to be applied when assessing the value of the inventory. So likewise, the construction contracts, deferred tax assets, assets from employee benefits, financial assets under IFRS 9, investment properties measured at fair value, and assets held for sale. So these assets will have different standards which we need to follow separately. Then what is an impaired asset? Okay, so what is an impaired asset? An asset is impaired when its recoverable amount is less than its carrying amount on the balance sheet. Now I explain you, we need to compare the carrying value of the asset to be compared with the recoverable value. If the carrying value is more than the recoverable value, the carrying value is 100 and recoverable value is 90. So therefore, we need to record an impairment of 10. So here, what does carrying value means? The carrying value means cost less accumulated depreciation. So that is the carrying value. So what is the recoverable value? Recoverable value means it is the maximum benefit. It's the maximum benefit from a particular asset. Okay, so how do you get a maximum benefit? You can get a maximum benefit either by selling the asset, or else you by using the asset in the business operation. Okay, so you can generate a maximum benefit, okay, either by selling the asset or using the asset in the business operation. Okay, so therefore when you calculate the recoverable value, so what you need to do is you need to identify the value, the higher of the selling amount or the value in use in the business. Okay, so selling amount means it is the fair value less cost to sell. So basically what you could get by selling the asset minus any cost to sell. Okay, so this is fair value less cost to sell, fair value less cost to sell, and value in use. So basically value in use means if the asset is used in the business operation, okay, business operation, you will generate cash flows. By considering these cash flows, we need to calculate the present value of the future cash flows expected from using the asset and then selling it. Okay, so basically how do you calculate the recoverable amount? Recoverable amount is the maximum benefit from a particular asset. To determine this, what you should do is you need to identify the fair value less cost to sell or the value in use in the business operation. So whichever is the highest, we have to select as the what you call the recoverable value. Okay, so let's say the fair value less cost to sell is for example, let's say 90, and the value in use is 70, the higher is 90. So that will be the recoverable value here. Okay, and compare with the book value or the carrying value, which is the cost minus accumulated depreciation. So the carrying value exceeds the recoverable value by $10. So this has to be impaired. Okay. So important thing is when calculating the value in use, do not include financing cost and the taxes. Basically, when you calculate the present value in your financial management, you will study this particular concept. When you calculate the present value, we don't consider the financing cost and the taxes. Okay. So next one is how to measure fair value less cost to sell. Basically, let's say you can use a binding sale agreement if available. If the sales agreement is available, so what you can do is you can use that particular agreement as your selling price, or else use the current market price, the existing market, minus disposal cost, if any, if an active market exists. Okay, so these are the two ways where you can identify determine the fair value less cost to sell. And how to measure the value in use, this already I explained. Estimate the future cash inflows and outflows from using that particular asset in the business operation, and use a discounting factor. Then you discount these cash flow using a suitable rate. Okay, so this is how we calculate the fair value less cost to sell and how the value in use. So we need to take the higher of these two as the recoverable value. Okay, so what are the indicators of impairment? So do we need to okay, the question is, do we need to do the impairment test every year? So this is a question. Do we need to do impairment every year? No. So the impairment is required if there is an indication. The indication exists, then you need to do the impairment. Okay, so each reporting date, companies must check if there are signs and indicators that the asset might be impaired. These signs can come from both outside and inside the company, external factors and internal factors. So basically, these are the external factors, external signs. Market value drops more than expected. Okay, for example, let's say there's a land you bought a land last year for $1 million. Okay, now due to a sudden drop in the property prices, this value drops to $500. Okay, $500,000. So from 1 million to $500,000. So therefore the market value dropped. So as a result of that, the asset has to be impaired. Or else negative changes in the technology, market, economy, or laws. Okay, if there is any technological obsolescence and out of date, if the technology goes out of date, so we need to impair the asset. And also interest rates rise, increase in discount rates and lowering assets value. Now we discuss in the value in use, when you calculate the value in use, we need to discount. Okay, to discount we have to use an interest rate. Okay, if the interest rate increases, your present value will fall. Okay, so that will result in lower asset value. So this is an indication. If the interest rate increases, this is an indication of the impairment. The internal signs: asset is obsolete or damaged. If the asset is damaged and which cannot be utilized, so then the asset become obsolete. Changes in how the asset is used or planned to be used. Okay, let's say now you had an asset, you shut down one division of a particular company. So the asset used in those divisions will become impaired. Assets economic performance is worse than expected. For example, let's say there's a machine, you expected that the machine will provide 100,000 units. Now when you use the asset, the actual performance is 50,000 units. The capacity reduced to 50,000. So this is an indication of impairment. So if any of these signs exist, an impairment review is needed. Okay. Okay. So when is annual impairment testing required? Even without impairment signs, okay, assets like these require yearly impairment test. Basically, goodwill from acquisition. So when you acquire a subsidiary, at the time of acquisition we calculate the goodwill. This is the purchase goodwill. This has to be annually tested. Okay, to identify any permanent reduction in the value of goodwill arising from any business changes or poor performance of the business. And the other one is the intangible assets with indefinite useful lives. So usually we don't amortize these intangible assets because of the useful life. It is unlimited, indefinite useful lives. So because of this, because the future benefits and the useful lives are uncertain, so therefore annual impairment tests are needed regardless of whether the impairment indicators exist to confirm the asset value is still recoverable or not. And also intangible assets not yet in use. So these assets are still being developed or under construction and have not started generating any cash flows. So since their future benefits are uncertain, so IAS 36 requires annual impairment test. Okay, so these are the instances where we need to do the impairment test even without impairment